Good afternoon. My name is Steve Janz and welcome to my video series. Today we're going to focus on the cash flow statement, and we're going to focus on basically two areas: calculating the dividends that are paid out by a company and calculating the first two main calculations using the direct method in the operating section. Let's get started. Dividends. How do we calculate the dividends that a company pays out in a year? Well, what we have to do is we basically have to understand the logic between how retained earnings work with regards to the income statement and its net income. So at the beginning of the year, 2017, end of year, beginning of 2018, our starting balance was $600,000. And in 2018, we had net income of $325,000. So in theory, if no dividends had been paid out, our retained earnings balance should be $925,000. But our balance isn't that. Our balance is $800,000. What that means is that dividends were paid out. And of course, by simple math, we can tell that $125,000 of dividends were paid out. We had $925,000 with our opening retained earnings of balance and our net income. Our closing balance was $800,000, which implies then that $125,000 of dividends were paid out. Let's move on to the direct method. The direct method is intimidating to a lot of people when they first start it because it involves numerous accounts for the calculations. I have found that over the years that if we start with our two basic and in some ways our main calculations, that it helps reduce the anxiety solving this problem, and we can then create a really accurate and proper cash flow statement in the operating section. Now, as you've heard me say in class and you'll hear me say in the video, the secret to doing cash flow is do journal entries. Go slow. Understand how to do journal entries with all of these numbers, making the default part of the journal entry cash, and it will really help you to understand, is cash going up or cash going down, and then that can help you solve for your values. Let's get started. The first one is all about cash received from customers. One of the things you'll see with the direct method is that a lot of times we will combine income statement values with balance sheet values. So here we have sales and accounts receivable. If you looked at the next one, we would have cost of goods sold, and then of course the two balance sheet values, inventory and accounts payable. So there's this combination effect. So when you're looking at this, don't forget to look at the income statement first, see if there's anything related, and then focus on the balance sheet account or accounts. So let's start with this cash received from customers. Accounts receivable has increased $90,000 from 2017 to 2018. Do a journal entry. What does that look like? And remember, the default is to cash. So if my accounts receivable is going up $90,000, here's what my journal entry would look like. Accounts receivable, $90,000 would be a debit. And again, what does that mean this time? That means that the default is cash, $90,000. And remember, this is a cash flow statement. So we're focusing on cash. So if my sales are 1.1 million, and this change we know is a reduction, credit cash, of 90,000, we then know that cash received from customers is equal to $1,010,000. That is our calculation. That's how we do it. And again, remember, the journal entries help tremendously. Let's move on to now the next calculation. Cash paid to suppliers. And you can see there's two accounts here. So what you have to learn is that cash received from customers, generally speaking, implies sales and accounts receivable. Cash paid to suppliers involves cost of goods sold, inventory, and accounts payable. Understand those basic counts are involved, and that helps you reduce your anxiety using the direct method. Again, Let's use journal entries. So if our inventory went up 40,000, our journal entry here would be inventory 40,000 as a debit. And of course, our credit will be the cash, the opposite. So this implies that cash is going down $40,000. Now, accounts payable. If our accounts payable in this case is going down, that implies that we are reducing our accounts payable. Now, if we're reducing our accounts payable, again, that'll be a debit. Accounts payable, 20,000. And the opposite is cash. Cash will be a credit of 20,000. So we've got our journal entries. We understanding that we are spending more for our inventory, more to reduce our accounts payable. So how does that apply to cash paid to suppliers? Well, we start with our cost of goods sold of 620,000. We then, because this is money going out, we're going to add 40,000 to this for the inventory. We're then going to add 20,000 for the accounts payable. Put it all together, and cash paid to our suppliers will equal 680,000. Follow these methods, and especially take your time creating the journal entries. And overall, I think you'll do great on this topic. Thank you.